Today, we will talk about the federal funds rate, what it is, how it's determined, and why it's important. The federal funds rate refers to the target interest rate range set by the Federal Open Market Committee. Simply put, it's the rate at which banks borrow and lend their excess reserves to each other overnight. Banks charge each other the federal funds rate for lending excess cash reserves on an overnight basis. The FOMC sets this rate 8 times a year based on key economic indicators like inflation and growth. These indicators inform whether the rate goes up, down, or stays the same. The FOMC sets the target federal funds rate as a guidepost, but it cannot force banks to charge the exact rate. Instead, banks negotiate the rate, with the weighted average known as the effective federal funds rate. The Federal Reserve can adjust the money supply to affect interest rates, and it also sets a discount rate for banks that borrow directly. The federal funds rate is crucial for several reasons. It influences monetary and financial conditions as well as short-term interest rates for consumer loans and credit cards. It also can impact the stock market, causing reaction based on any changes. The federal funds rate is simply the interest rate that banks charge each other for overnight borrowing or lending. This process ensures that banks help each other maintain the required reserves needed to cover depositors' withdrawals and obligations. The Federal Open Market Committee meets 8 times a year to determine the federal funds rate. Their decision is based on key economic indicators, like inflation and economic growth, giving insight into the economic health of the country as a whole. The main difference lies in the fact that the federal funds rate is specifically the rate at which banks lend to each other overnight. This indirectly impacts short-term interest rates for consumers and businesses. Stock markets are also highly sensitive to changes in these rates. Here are 3 key takeaways. 1. The federal funds rate refers to the target interest rate set by the FOMC and influences overnight lending and borrowing between banks. 2. The FOMC sets the target federal funds rate 8 times a year, taking into account key economic indicators to determine the economic health of the country. 3. The federal funds rate can affect short-term interest rates for consumer loans and credit cards, and it can also have an impact on the stock market. Hope this would help. Thanks for watching.